The net worth of an individual or business describes how much a company or person is financially worth. You can determine this value by calculating the value of the assets owned and subtracting the liabilities owed. Companies use this metric to determine their organizational health, as the net worth summarizes a company's current financial position. You may apply this quantitative concept to individuals, businesses, sectors, or countries. Business professionals may also refer to net worth as book value or shareholders' equity. Financial professionals describe the net worth as being positive or negative. Those with a positive net worth have more assets than liabilities, and those with a negative value have liabilities that exceed their assets. A positive net worth indicates good financial health, whereas a declining net worth may indicate a decrease in assets compared to liabilities. Those with the excessively positive net worth are called high net worth individuals. Inflation describes the decline in purchasing power of a given currency over time and refers to the sustained increase in the price of goods and services. As the cost of goods and services rises, your ability to afford the same items decreases, meaning your money has less buying power when inflation increases. Working professionals may consider how their employer is raising their wage or salary proportionately to the rate of inflation. An increase in a country's money supply typically causes inflation, although other factors may also affect a currency's value. Financial professionals typically use the Consumer Price Index (CPI) and the Wholesale Price Index (WPI) to determine the rate of inflation. Individuals and businesses with tangible assets can benefit from an increase in inflation, as it indicates an increase in the value of their assets. Liquidity refers to the accessibility of money or the ease with which you can convert assets into cash. When referring to assets, the most liquid of all assets is cash itself, whereas tangible items are less liquid. For example, real estate is generally not very liquid, as it takes time to build value, and selling these assets can also take time. To evaluate liquidity, financial professionals may use the current ratio, quick ratio, or acid test ratio, or cash ratio. The two main types of liquidity are accounting liquidity and market liquidity. Accounting liquidity refers to a business or individual's ability to meet their financial obligations if their debts become due. Market liquidity refers to the extent to which a market, such as a real estate market, allows assets to be bought and sold at transparent prices. If markets are liquid, it's difficult for sellers to convert their assets into cash. A bear market shows that the market is declining, indicated by high unemployment and falling share prices over an extended period. A bear market provides an opportunity for investors to purchase stocks at lower prices to hold until the market rebounds. During this time, many investors may sell their shares to convert them into more liquid assets such as cash. A recession doesn't always follow a bear market, although this is often the case. Hello and welcome to our podcast on ROI. And in this episode, we will discuss everything you need to know about ROI. ROI stands for Return on Investment, and it is a financial metric used to measure the profitability of an investment. To calculate ROI, you need to take the net profit of the investment, subtract the cost of investment, and then divide the result by the cost of investment. For example, if you invested $1,000 and earned a profit of $2,000, then your net profit would be $1,000. To calculate your ROI, you would divide your net profit of $1,000 by your initial investment of $1,000, giving you an ROI of 100%. ROI is a critical metric for businesses as it helps them determine the profitability of their investments. By calculating the ROI of a project or investment, businesses can make informed decisions about where to allocate their resources. A high ROI indicates that an investment is profitable, while a low ROI suggests that an investment may not be worth pursuing. ROI is not the only factor to consider when making investment decisions. It is also important to consider the risk associated with an investment. An investment with a high ROI may also be high risk, while an investment with a low ROI may be lower risk. It is essential to weigh the potential return against the potential risk before making any investment decisions. In conclusion, ROI is a critical metric for individuals and businesses to consider when making investment decisions. It provides a clear indication of the profitability of an investment and helps inform decisions about where to allocate resources. However, it is important to consider the potential risk associated with an investment and weigh it against the potential return. Thank you for listening to our podcast on ROI. When it comes to managing your finances, having the right mindset can make all the difference. Your money mindset is your unique set of attitudes and beliefs about money, and it can have a big impact on your financial decisions. One way to improve your money mindset is to start by examining your beliefs about money. Do you believe that money is scarce and hard to come by? Or do you believe that there is plenty of money to go around? Another way to improve your money mindset is to start tracking your spending and saving habits. This can help you identify areas where you might be overspending or where you could be saving more. You can also work on developing a growth mindset when it comes to money. Instead of thinking that you are stuck in your financial situation, focus on ways that you can grow your income and improve your financial situation over time. Finally, it can be helpful to surround yourself with positive financial influences. This might mean reading books or blogs about personal finance or seeking out the advice of a financial advisor. By taking these steps to improve your money mindset, you can start making better financial decisions and building a more secure financial future for yourself.